mentioned, I founded Esplanade over 25 years ago, and for almost all of those 25 years, we've been investing actively in renewable energy, different forms of renewable energy, what is sometimes referred to as the energy transition. Today's presentation, we've entitled Drill Baby Drill. With all due respect to Sarah Palin, former vice presidential candidate, we are not talking about drilling for oil, drilling for natural gas here. We are talking about drilling for heat, specifically a base of geothermal power to generate electricity. This is talking about wide moats. And we think this business does have a very, very nice moat. They generate electricity, as we know, and as we'll discuss, the world is in desperate need of electricity. And these are projects that are very difficult to get done, take years to get done. And by virtue of that, this company that we'll describe in a few minutes, Polaris Renewable Energy, has created quite a nice little moat for themselves. So with that said, we'll jump into this presentation, Drill Baby Drill. The disclaimer that you all are used to. And before getting into the details of the investment, I'd really like to say that, at least in my opinion, John, some investments are complex. They're hard to understand. They require different types of mental gymnastics or maybe even a little calculus. This one is pretty straightforward. That is not to say that it is riskless, but it's not complicated, and uh, we like that. Complicated is wonderful if that's what gives you the edge, but in this case, we think this might be a little bit on the easier side, and in some respects, hiding in plain sight. So today, thank you for joining us on this adventure. We are going to go to some exotic locations. Unfortunately, we are not going to Club Med. We're not going to some wonderful Caribbean luxury resort or South America or Southeast Asia to go windsurfing and sit at the beach. We're going to different exotic locations. Some of the same geographies, Latin America and the Caribbean specifically, but we're here to talk about Polaris Renewable Energy. Polaris Renewable Energy operates primarily in 6 geographies with really 7 power assets scattered around Latin America and the Caribbean. And before getting into the business fundamentals, I really just want to set the stage for the business itself. And so we're going to take a few minutes and just share what these businesses are, where they are, why they matter. And we're going to start up in the upper left-hand corner in Nicaragua. Nicaragua is this company's original asset, the San Jacinto geothermal asset. It is 82 megawatts of geothermal power. This is excellent, steady baseload electricity generation, and it's been operating since 2013. If we skip to the lower right-hand corner down to Peru, we start with a 5 megawatt hydroelectric asset that's been operating since 2015. Also in Peru is a larger 28 megawatt hydroelectric asset operating since 2019. We'll skip over to Ecuador on the lower left-hand side of the page. This is another hydro power asset operating since 2025 of 6.75 megawatts. We move up to the Dominican Republic, Canoa 1. This is a 25 megawatt solar asset this time. You'll see we've moved from geothermal, broadening into hydro, now solar. This asset has been operating since 2020. The company purchased it in 2022. Moving to the lower left-hand corner, Vista Hermosa in Panama. This is another solar power project, a 10 megawatt solar power plant operating since 2023. And last but not least, in the middle right-hand side of the page, we are on to Puerto Rico. the Punta Lima wind power, a 26 megawatt wind asset, again, adding wind to this increasingly diversified portfolio. This asset has been operating since 2024, and the company has made a $20 million investment for a controlling interest in what is a 20-year PPA, a power purchase agreement with PREPA, the Puerto Rico Electric Power Authority, the newest asset in the portfolio that will and has already started to show its cash and EBITDA generation characteristics thus far in 2025. We can take a breath now. We're done traveling. Before moving to the business fundamentals, I want to say that these are obviously not riskless geographies. These are not riskless counterparties. Uh, However, the company has demonstrated for over a decade now a real ability to find, develop, build, manage, and own these power projects with very successful, relatively stable, multi-year arrangements. So despite the call it less than AAA geographies and counterparties, these have proven to be reliable and very, very durable assets, again, continuing to build the moat I discussed a bit earlier. So let's lift it up a little bit. Let's talk about the company itself. Polaris is a Canadian company. They own, operate, develop, and acquire renewable energy projects in Latin America and the Caribbean. Based in Toronto, their market cap is approximately $253 million Canadian. That is the last time I will speak in Canadian dollars. That converts to roughly 185 million US dollars as of last week. And all of their financials, their dividend, all of the numbers I'll use here are in US dollars. It's really only the stock itself that is referenced in Canadian dollars. They do have substantial net debt, although they're relatively underleveraged for their peer group. They have approximately $127 million US in net debt. That is comprised of $219 million in gross debt, less $92 million in cash. That's over $4 a share in cash. The $200+ million in gross debt is made up of green bond, which they floated last year, and some asset level debt. Just so you have a sense, the green bond is a 5-year bond paying a fixed 9.5% yield. The green bond allowed them to fix and term out some floating rate assets at what at the time was a slightly improved interest rate. Next, they pay a substantial dividend. They pay a 60 US cent per year dividend, approximating a 7% dividend yield. We'll discuss this more later, but this has been stable for several years. Their enterprise value to EBITDA is 5.4 times by our math and our Esplanade Capital analysis. This is not meaningfully different than the coverage they have among the analyst community, including National Bank of Canada and Cormark as examples. I'd pause there for a moment and say, if the profitability, if the EBITDA, the cash flow generation were very volatile, if this were somehow peak or near peak earnings, then we at Esplanade Capital would say, well, 5.4 times seems cheap on the surface, but really isn't. Given the stability of this business, the assets, the profitability and cash flow, we think this is extremely cheap. Certainly relative to peer multiples, which you'll see in a moment, but more importantly for us, just in an absolute sense. The business generates substantial free cash flow. This is sometimes referred in this industry to as CAFD, cash available for distribution. We calculate their free cash flow yield to equity at 15.7%. Again, very attractive to us. And this includes approximately $5 million in debt paydown. Uh, that is not cash available for distribution, but as we really think about value each year that is accruing to equity holders like us, uh, adding back that $5 million a year leads to an accretion percentage somewhere in the 18% range. And then finally, a few more thoughts. One is I will acknowledge bluntly that this company has a history of what I would call modest overpromising and undelivering, not disastrous, not laden with surprises. I wish they modestly underpromised and overdelivered, but I think we've seen a little bit of time creep and value creep, just a little bit of overpromising and underdelivering. Our estimates and the way we think about the value here fully incorporate those. But the bottom line is that this is a stable and cheap business. We see at least three paths to substantial upside over the next year or two. And we think this opportunity exists because they're in this, smaller, underfollowed sweet spot of not being so small, but not being large enough to be competing with some very large, very established players who love these renewable assets around the world. These are the Brookfields, the pension funds, Ormats, KKRs, TPGs of the world. Uh, we think that's a very good place to be. And as they maintain and perhaps add some scale, we think this is and certainly can become a very, very interesting acquisition candidate if and when the board is so inclined. So I started and titled this on a riff of geothermal, and so I just want to start there. Geothermal is their original asset. That does represent the majority of their revenue, cash flow, and value today, though that number is coming down. And the bottom line is geothermal is one of the few things that people actually agree on. At least in this country, as one example, Democrats and Republicans both seem to like geothermal. The data center, the incredible demand for electricity that we're seeing in North America and around the world that is really lifting all electricity generation boats, loves 24/7 carbon-free electricity. And while we are very interested in things like solar, solar does not allow for 24/7 baseload electricity generation. In fact, there are very few things that do in the renewable world. One is nuclear, and we've seen how many nuclear stocks have been booming recently. One is hydro, and one is geothermal. Even Donald Trump likes geothermal, and certainly his Secretary of Energy, Chris Wright, as you'll see here, states, geothermal hasn't achieved liftoff yet, but it should and it can. Geothermal is actually a wonderful place to be nowadays. I had mentioned earlier that this stock is a good value. We think it certainly is compared to its peers, all of whom are much larger and operate in geographies that have very different risk profiles. They all trade at 2 times Polaris's multiple. We list some public companies below. Companies like Boralex, a Canadian IPP, trades at over 11 times. Brookfield, a behemoth in the industry globally and certainly in Canada, 13.7 times. Clearway Energy in the United States, also coincidentally 13.7 times. Intergex, a Canadian renewable IPP, is being acquired. We'll come back to that. 11.4 times. Northland in Canada, 9.5 times. The average of these peers, again, an imperfect peer group, trades at 11.9 times, where little Polaris trades at less than half of that, 5.4 times. On top of this, I would add other peers like Ormat, potentially a marvelous acquirer of Polaris, trades at more than twice their multiple. And finally, private companies. And this is partly anecdotal evidence, but private companies of any scale trade at meaningfully higher multiples. Again, just unleashing the potential universe of strategic and financial acquirers for some or all of Polaris's assets. Despite all of the macro uncertainty, despite the uncertainty of tariffs and trade policy, the one big beautiful bill, the investment tax credit, et cetera, deals are actually getting done in the energy business, in the renewables business. Two of the companies in our universe alone have received takeover offers from highly respected acquirers thus far in 2025, despite all of the uncertainty with policy, specifically in the United States and North America more generally. One, Interjex received an offer from the giant CDPQ at an 80% premium. A much smaller company, Altus Power, focused on commercial and industrial solar, received an offer from TPG, 66% premium. These are very generous premia, and they again just show that despite the cloudy environment, specifically in North America, these assets are highly coveted. Deals are getting done. We think that bodes well for ultimately the stock and potentially the acquisition universe for Polaris. So I've given you some of the numbers, but I just want to take a moment here and go very quickly, line by line, to why we think this cash is substantial, durable, real, sustainable, and maybe worth your time and interest. At the very top, uh, their estimated revenue for 2025, again, these are Esplanade numbers, but these are largely consistent with sell-side research. This is an $82 million revenue company. However, adjusted EBITDA, and though it is adjusted, this is more or less real EBITDA. There aren't any, let's call it sort of funny tricks or pathological one-timers in there. EBITDA is approximately $58 million. Yes, you read that right. This is roughly a 70% EBITDA margin business. They have cash interest of approximately $21 million. Again, that includes the green bond and other project level debt. Maintenance CapEx is tiny. For all of these assets, we're talking about $3 million. Now, occasionally they have opportunities to upgrade, enhance, add capacity. We think they can do those at very attractive rates of return, but just maintenance CapEx, about $3 million a year. And what you're left with, I mentioned this concept earlier, is equity accretion of about $34 million. Again, these are all US numbers. That's an 18.4% effective yield on the current equity value. Debt repayment of approximately $5 million. So all in, we have free cash flow, or as I mentioned earlier, CAFD, cash available for distribution, of approximately $29 million, implying a 15.7% free cash flow yield. Now they take almost half of that, almost half, and pay a dividend of 60 cents a year, which equals approximately a 7% dividend yield. And this yield has been incredibly stable over the past 6 years. It's a 7% yield, approximately 45% of free cash flow. And when we go back and look at the history here, and I admit that yield says 7.37% because it's keyed off of the most recent quarter on Bloomberg. Once upon a time, back in 2015, 2016, the company didn't have a dividend. They initiated a dividend. It grew steadily through 2016 into 2017. and in 2018 stabilized, plateaued at where it is now, 15 cents a quarter, 60 cents a year, the current yield. Quite frankly, I think it was a mistake to have that large dividend back then. I think it's a mistake to have kept it that high. We would have strongly preferred opportunistic stock buybacks, particularly at times such as today. And we think the dividend is higher than it needs to be. We fault the board. The board occasionally talks about increasing it further. We think that would be a mistake. However, we acknowledge, at least for now, that we're stuck with it. Once you have a dividend, again, particularly in such a stable business, we think it would unnecessarily spook a bunch of investors were they to lower it. We would much rather see that happen and use that to do things like buy back stock. But for the moment, our base case is that we're stuck, quote unquote. I guess there are worse things, with a 7% dividend yield. As for the stock, which is what you all came here to see, the stock has really gone nowhere over the past 5 years, although it's gone nowhere, I say volatilely. I believe that's actually a word, even though it sounds awful. It's gone nowhere with high levels of volatility. As you can see, it was a little bit higher than where it is now back in the 2020 timeframe, and then spiked. There was substantial interest in renewable energy assets. The stock basically doubled versus where we are today at approximately $12 a share Canadian, and then proceeded to collapse throughout 2021, spiking in 2022, collapsing again, and more or less bouncing around in the same general ballpark in the low teens of where we are today. We don't love volatility. We admit that we have used this to trade around the position in recent years. Uh, I do think an option, potentially, is that we continue to see volatility despite a relative lack of volatility in the underlying business and cash flows, but just based on the whim, the taste, the fashion of investors. And that can be an opportunity potentially to start or add more, or potentially to trim or exit the position, even if nothing incrementally good happens in the months, quarters, and years to come. As I mentioned, despite the stock volatility, the results have actually been flattish. What really happens is that they're flattish for a period of time with an occasional step change, which reflects the addition of new assets, all of which have been paid for. As we said, there's only a few $1,000,000 in maintenance CapEx, but once in a while we get this step change bump because of these quasi-organic but typically inorganic investments. When we look back at 2021, for an example, uh, generated $43.8 million in EBITDA, relatively stable into 2022, but then in 2023 had one of these step function changes. Why was that? How did EBITDA rise so substantially to $57.7 million? One, they had acquired their Panama asset, the Vista Hermosa solar asset I mentioned earlier. Two, they made an investment in a binary unit, increased capacity for their Nicaraguan geothermal power plant. And three, they had a full year of an investment they had made. This is the Canoa One investment in the Dominican Republic. All of these things hit. They used their robust balance sheet to make these investments. We saw the fruits of those investments fully in 2023. Again, nothing much happened in 2024. Again, some year-to-year vagaries and volatility, but we'll see a modest uplift in 2025 as the Puerto Rico Punta Lima wind asset starts to show its EBITDA generation abilities. That's an asset that the company is guided to $3 to $4 million in EBITDA and cash flow. Again, you'll remember that is versus an investment of $20 million US.